Hi, my name is Nicole Dennis from Bloomberg Tax. Joining me today is Darian Harnish, a provision specialist, and today we're talking about how tax technology can help us comply with the new FASB ASU 2023-09. Darian, can you tell us a little bit about what that is?
Yeah, so the FASB released ASU 2023-09 in late December of 2023. And we've had some time to digest a little bit of what's in there. The FASB ASU is a result of a long-term project to enhance and increase the amount of information available related to income taxes in financial statements. And so while the initial project included quite a significant amount of information around NOL expirations and various provisions, when it came down to it, the FASB narrowed it down to really two different disclosures that they wanted to focus on and which became effective requirements under the ASU. And so that's a enhancement around the effective tax rate and the disclosures there, and then a additional disclosure around the disaggregation of income taxes paid. In the further disaggregation, they're looking for specific jurisdictions that make up more than 5% of the net amount of paid or received in the year. And that gets a little bit more technical, but that's the general concept around where they're looking for additional amounts disclosed around paid income taxes. But a lot of the focus has really been on the effective tax rate because it's a much more significant requirement to get to the format that FASB has required. And if we look at the requirements, there are some basic things like FASB has added a requirement or adopted the SEC's requirement for a 5% disclosure threshold. So a lot of public companies are already meeting that. There is the added disclosure to do in both percents and dollar amounts. So all rate reconciliation tables going forward will have both dollars and percents, whereas right now they might have dollars or percents. Where companies will have to do the most work is around putting items into the new categories that are very prescriptive. And so the FASB has laid out specific guidance with respect to those categories, what should go into the categories such as changes in tax law, states, foreign jurisdictions, credits. All of those items have very specific requirements now of what should be included in those categories. So there should be more consistency and comparability across various companies' ETRs. There's also the additional disaggregation requirements that a lot of companies post TCJA and probably even before were putting all of their foreign tax effects, whether it's the rate differential or GILTI or FDII or kind of anything related to those foreign jurisdictions, they're putting them into one line that said the effect of foreign entities or something along those lines. And the FASB requirement really breaks down that line for a lot of companies and says, okay, we want you to look at jurisdictions now and disaggregate where a jurisdiction makes up 5% of the items impacting the ETR. And from there within a jurisdiction, you might have to disclose non-deductible or non-taxable items for that specific jurisdiction or credits for that jurisdiction and really break down those foreign line items. So in that regard, there's a lot of information that was getting aggregated and kind of buried in an effective tax rate that now might have to be pulled apart. And so companies are going to see their rate recs get a little bit longer and more data intensive to pull together.
What does it mean for companies that are adopting this prospectively or retrospectively? And where are the challenges?
So the FASB allowed for prospective adoption in the ASU standard when they released it, which I think a lot of companies were very supportive of because it means that on a prospective basis, I only need to get this year's rate rec in accordance with the FASB requirements. So that's a lot less work than having to do 3 years of a rate rec based on the FASB requirements. But as we talk to a lot of our clients, the tax department is very much all in favor of forgetting the past, moving forward in compliance with the FASB requirements. But a lot of financial reporting departments recognize that there's important considerations in comparability, looking at 3 years of rate recs that are the same, and there's the added frustration of having two different rate rec tables in the footnote, because you're going to have 2 years for the historical information that look very different than the current year under the requirements of the ASU. Having that conversation within an accounting department to make sure that everyone's on board with either going prospective as the ASU allows, or doing the retrospective option, which is a permissible option in the ASU as well, is really critical, because there may be different considerations, and which is easier is not always the primary consideration that wins out, right? So it's important to have that discussion now, because retrospective adoption does mean more work for tax departments.
So Nicole, tax technology can be used to help comply with the requirements in FASB ASU 2023-09. Can you talk a little bit about how technology can be used by corporate tax departments to meet the requirements?
One of the good things about technology is that it occurs in real time as far as tax rates are concerned. The tax rates that go on to the tax return, and not a blended rate being used, it's the actual rate. That is critical in the new ASU standard, because it gives you the actual impact of the state taxes that have to be disclosed in the rate rec based on the ASU's more than 50% effect on the rate rec. Also, you're able to track your NOLs pre and post, and based on the filing requirements for each state, whether it's a combined state, it's a nexus state, it's a unitary state. If you have great technology, it's in real time and you can track everything. So that's one of the great things about having great tax technology. Another thing is that there's great audit control, where you can extract reports from a tax software to give to your auditors. That cuts down time, because sometimes if you don't give the auditors exactly what they need, it takes a lot more time to get through an income tax audit. So if you give them Excel reports that are, they can see where the formulas are, it cuts down the time of all the questions that they ask, and you get through the audit faster. Another thing I would stress is internal controls. It's always great to have a system that can track different versions, as well as who did what when. So like a time and date stamp, the name of the person that made the change. And also lastly, one thing I think that is very critical is when you're going through provisions, there's the ability to have last minute changes. And if you have a great system, it can pick those changes up very quickly, so that you don't have to spend time figuring out what the difference is or what your late entries or adjustments are. So I think having a great tax technology system or software will help in many ways, especially time saving.
Yeah, I mean, it's not just time with your external auditors, right? It's time with your internal audit team as well, right? When you can show them where they're trying to get adjusted to this new rate reconciliation, and you can show them how all the pieces are built up right in the system and convert right to outputs, right? That's a huge time savings.
It's a huge time savings, because, we're talking about the state line specific that the ASU has prescribed now. Many things go into that line. So instead of having to hunt and fish and peck to get that number, if you have a tax software that picks up the items that goes into there seamlessly, then you won't have to spend so much time and effort putting that number together.
Yeah, I also think about how so many tax departments, they might have foreign controllers who are sending up Excel packages.
Yeah.
And maybe the provisions get recorded in the local country, right? Well, with a consolidation tax provision software, right, you can pull all of that detail right up to the final deliverable. And for ASU 2023-09, a lot of that's going to be required now, right? So they can break down the ETR and really pull into those foreign jurisdictions and make sure they have all of the items that are required to be disclosed.
Great point, Darian, especially, for multinationals who are recording in a different rate, bring it in over to the U.S. rate. Our system or tax software can do that seamlessly in terms of, converting from in-country rate to a USD rate and calculating any rate differentials.